Good afternoon, everybody. Welcome to the Fuels Institute contributor-only live webinar presentation of 2020 Global Sulfur Limit, Should You Be Concerned? My name is Amanda Applebaum. I'm the Director of Research here at the Fuels Institute. And today our presenter is Beth Brown. She is the Managing Editor of the Fuel team for S&P Global Platts. S&P Global Platts is a price reporting agency. They provide information and benchmark pricing for commodity and energy markets around the world. Beth has been with Platts for 4 years now and mostly focusing on the distillate markets in the U.S. and Americas. Today, she's going to give us an overview of what the fuels market can expect as a result of IMO 2020, including how new blends of compliant fuel are expected to impact diesel demand and pricing, residual impacts on the gasoline and jet fuels markets, as well as projected impact of scrubber adoption post-2020. Our discussion is going to last approximately 25 to 30 minutes, after which point we'll have a Q&A session. If you'd like to ask a question, please feel free to send those to me or a panelist, and you can do that by clicking on your chat box, which should be in the lower right-hand corner of your screen. And in the chat box, you can type your comments or questions. I'll just let you know anything that Beth does not answer during the webinar. Again, we will bring up and ask her at the end. So please send in your questions whenever you have them. Lastly, if you have any technical difficulties during the session, please email Donovan Woods at dwoods@fuelsinstitute.org. And lastly, if you'd like to be added to our newsletter or be notified of our next webinar, please email Donovan Woods again, and he'll be sure to include you. So with that, I'm going to hand it over to our presenter, Beth.
Hello, everybody. Like Amanda said, my name is Beth Brown. I'm very happy to be talking to you guys today. Like she said, I'm going to be focused on the impacts that IMO 2020 are going to have on the on-road and jet fuel transportation markets. So going into the agenda, I'm going to spend exactly one slide explaining what Platts is, because it will kind of give you a flavor of the perspective that I'm coming at this at. And then we'll talk about a little bit about what's happening in today's current market for gasoline, diesel, and jet fuel, because this will help us understand how the specific supply and demand fundamentals that are impacting those markets now will be impacted by IMO 2020. Then we're going to go right into IMO. I'll kind of explain what the background is and how we expect blending, particularly of gasoline blend stocks, will impact the IMO demand, and how that will have kind of a I guess, domino effect on the rest of the refined products markets. We'll look at how the impact has changed even over the last year. This is something that's very dynamic. People are still trying to figure out what the impact will be, so I'll kind of look at that and how it's been changing. And then I'll also touch on scrubber adoption rate, which will obviously be something that will majorly impact everything. So to start off, Platts is a price reporting agency. I myself am a price reporter. I spent most of my time here reporting on the diesel market. So every day we are coming up with the daily price, which then commodity, trade houses, refiners, different market participants can use as a benchmark or an index upon which they can buy and sell and base their contracts. So we are very in touch with the spot price of these markets. From there, we do things like market reports, which is a lot of what I'll be sharing with you today, a lot of the analytical forecasts of what we think are going to happen, as well as just, I guess, merging the prices with what we know is happening in the markets. Big part of that is the breaking news, and then the assessments. These are the price assessments. So a lot of what I'm focused on is the price specifically. What is the price going to be doing, and what are the fundamentals underneath that going to be bearing out? So with that, I'm going to start by looking at the refined products cracks. So this is Gulf Coast diesel, jet fuel, and gasoline. Gulf Coast, mostly Texas. These are the bulk of the refiners in the U.S. What are their cracking margins? If you look at the WTI crude, the benchmark in the U.S., how profitable are the major refined products right now? Going back the last couple of years, you see that there are kind of seasonal trends. That huge spike is Hurricane Harvey, But since then, you really start to see that diesel and jet are much more profitable than gasoline. Gasoline has been consistently the least profitable refined product to be making out of a refinery. It's due to a lot of different things, but you've started to see that separation. This is only expected to be kind of highlighted going into IMO 2020. The distillate products are going to be a huge blending component to making 0.5% sulfur compliant fuel. So this separation that we're already seeing between diesel and jet and gasoline could be even further in the future. So I'm going to talk about why this is happening and how this might be impacted. It's also important to note that the outright price of diesel, which is the red line in that graph, has been fairly stable and was increasing throughout a lot of this year. It's kind of fallen off a bit, but the differential, which is kind of the way that we look at it because it separates out what is essentially the price of crude from what is the fundamentals of diesel, the differential has been quite stable. So the diesel prices have been increasing despite the fact that actual supply and demand within the diesel market specifically has been pretty balanced. So this is only going to become more highlighted when there is so much more diesel demand coming online in 2020. So to explain a bit more about what's happening with diesel, you have to look at what is demand for diesel in the US right now. There has been a healthy economy, which is always going to correlate very closely with diesel demand. When there's just economic activity, that is always going to translate to strong diesel demand. Diesel is actually a little bit unusual because usually when there's a strong economy, people start looking at increased prices, and then that tends to, at some point, have a negative impact on the gasoline demand. Diesel is the opposite. You see a strong correlation there. But in addition to the economy, we've also had a lot of crude production lately. So the chart here just is showing you one crude play in Texas, the Permian Basin, how many rigs we currently have and how much production is coming out of them. This doesn't seem like a diesel story, this is crude, but for every rig that there is in the US, it requires diesel fuel. It requires diesel for the machinery, it requires diesel for the transportation. There's just a lot of hidden diesel demand within drivers like crude in the economy. So I think you'll see that projections for how much diesel prices are going to increase in the future with IMO have actually been trending down over the years because people have become a bit more worried about the sustainability of our strong economy. But something like strong crude production is going to remain no matter what. There will be a break-even point at which point the rig count starts to come down. But for the most part, economic activity like crude is not so much tied to the general economy like you would see a lot in the diesel demand. Another thing that's been supporting the diesel market in the US is that we haven't had that strong contango that we've had over the last few years. If you just look at the underlying structure in the market, it is always, up until this year, really paid off for you to simply hold barrels in storage because we've had enough of a contango to not only support the storage cost. You put the barrels in tank and then you have to pay, and you can take them out later and you can make money off of it. Right now, over the course of this year, that contango has disappeared, and eventually right now we're actually in a backwardated market, which is a sign of a very strong prompt market and a weaker market in the future. So what this has done is it's basically meant that we have declined in stocks for a lot of this year. So going into 2020, what the market structure is going to be is very important because it's going to tell you how much people have already put in tank in order to be ready to be blended for fuel oil. The other thing that is bearing out is that we've started to see that domestic arbitrages within the US are starting to work a bit more than they have in the past. What I'm showing you here is the difference between the Gulf Coast price and the price in the Atlantic coast. One of the most traditional ways of measuring arbitrages within the domestic US is, can I take my barrel that I'm making in the Gulf Coast and ship it up to the Atlantic coast and make money off of that? The way that works is on something called the Colonial Pipeline. It's the biggest refined products pipeline that we have in the country. And what people usually look for is, can I make my barrel in the Gulf Coast, pay the cost that it costs to ship on the pipeline, and then get it to the Atlantic coast? That cost is about 5.25, which is why I have that slightly darker black line on this chart. anytime that you see these prices, which is the price spread between the Gulf Coast and the Atlantic Coast, whenever it's below that darker black line, that's a sign that this arbitrage has not worked. One of the biggest reasons that the arbitrage hasn't worked, except for kind of big spikes like Hurricane Harvey, and then more recently what's happening right now, is that we've had such strong exports of gasoline, diesel, and jet that the Gulf Coast market has been mostly focused on supplying other countries rather than supplying the domestic U.S. markets. It comes purely down to where can I make the most money. And when Mexico is importing at record levels of gasoline, when Brazil is importing at record levels of diesel, Gulf Coast refiners are going to send their barrels where they can make the most money. But as you can see, what this has done recently is, particularly with end-of-year sell-off, we've had an open arbitrage between the Gulf Coast and the Atlantic Coast, which is similarly mirrored in the Gulf Coast to, say, the Midwest or to other places that you can ship your barrels, which means that exports, while they are definitely still happening, are not the only play for a Gulf Coast supplier. You're looking to supply within the U.S. too because your arbitrages are open. How this is impacted by IMO 2020 will be interesting because each market, each one of diesel, jet, and gasoline have slightly different fundamentals, which I'm going to get into in a second. This is gasoline. This is just looking at gasoline production in the U.S., which is going to be one of the main things people are debating about when it comes to IMO. This is year-on-year production of gasoline, and I highlighted the darker black one as 2018. So it's kind of, on top of each other, but for the most part, 2018 gasoline production has been in the upper band of the last 5 years of production. We've had strong production, but it's because we've been keeping up with both domestic and foreign production. The U.S. has a very kind of yin-yang production-demand correlation because we have very strong demand seasons in the summer, and the South America, Mexico regions of the world have very strong demand in our winter. What we've seen recently is where you would typically see gasoline production fall off in the winter season in favor of diesel. That's kind of started to stabilize because we've had so much demand to export. So we've actually created kind of year-long gasoline demand. The reason why IMO 2020 would impact this is because a lot of what it takes to produce gasoline, some of the blend stocks like VGO, straight run for your feedstocks to your refineries, these things might be impacted because you're going to start to see that pull into the fuel oil blending. So whether gasoline production can take a hit is something that I'm going to talk about in a little bit here. Just talking about exports very quickly, this is how much the U.S. has been exporting to various countries. I just picked out really the biggest 3 countries that we send diesel to. It's Brazil, Chile, and Mexico. Mexico has consistently been very strong, but they did kind of tailor off for a lot of this year, but you're starting to see that growth again. A lot of the tailing off has come around the political uncertainty after the elections, whether they're going to build a new refinery, how they're going to handle their own crude. So you did start to see that drop off, but it has been growing a little bit recently. Brazil was the same way. They actually had subsidized their diesel pricing, which is why you start to see that the diesel demand to export to Brazil fell off a bit this year, but you're starting to see it rebound again. So, and Chile has been stable but growing, I would say. These are all very important because we are still focused on, supplying the domestic U.S. market while also supplying these major countries that use tons and tons of these refined products. So these are countries that are trending up in their diesel demand at the same time that all of this extra demand for IMO 2020 is coming online. So this is something that I'm going to pay attention to in a second, because keeping in touch with what the trends are in the world, really, this is how the world was looking in 2014 when it came to on-road transportation fuel for diesel. How much sulfur do you allow in your diesel around the world? There are a lot of colors on here, but basically if you are a shade of orange, then you allowed a very high sulfur diesel. A lot of Latin America, Africa, and even some parts of Asia did allow pretty high sulfur diesel within their country. So the ultra low sulfur diesel, what we use and what would be impacted by IMO 2020, wasn't what a lot of the world needed. They could take something with more sulfur in it. However, this is 2014 and this is 2018. I'll flip back and forth just to compare. But there's significant desulfurization happening around the world. in South America in particular, you might be looking at that and thinking, well, it still looks pretty orange. Surely they're not taking the ultra low sulfur diesel that we need and that would be demanded for IMO. But this is kind of misleading because while countries like Brazil and Peru and Argentina look orange here, what you're actually seeing is that certain rural parts of those countries do allow a high sulfur diesel, but for the most part, these are countries that take and need ultra low sulfur diesel. So their orange is actually pretty much a very dark blue. These are all countries that take ultra low sulfur diesel. The major one is Mexico. You see that they still can allow up to 500 parts per million of sulfur in it as opposed to 15 for ultra low. That is about to change for diesel in 2019. So right now, what is on schedule is that they're going to move to a maximum on-road transportation fuel of 15 parts per million in 2019, in January of 2019. So what that means is that they are going to be more import dependent, and those imports just naturally, based on proximity, are going to come from the U.S. The U.S. is going to be needing to supply more ULSD to Mexico because right now they have 6 refineries. They don't typically run at very high rates. On average, they've been running about 50%, I would say, if you round up a little bit over the course of this year. Within that 50% that they've been running, they only make about 20% diesel. And within that 20%, only about half of that is ULSD, ultra low sulfur diesel. So you're talking about a very small percent of the refined products that they're making will actually be able to be used within their country in a month's time. So they're going to have a lot of the higher sulfur diesel that they can't use anymore and a lot more need to import ultra low sulfur diesel. This is all kind of coming to a head at the same time before IMO even happens. So just to put it into perspective, Mexico, or Pemex, who runs the refineries, makes about 45% ULSD. And the U.S. makes almost 95% ULSD. We make almost no low and high sulfur diesel. Basically everything we make is ultra low sulfur diesel. So I mention all this because it is another thing that's kind of highlighting why diesel and gasoline are separated in price so much. So this is just looking at the NYMEX contracts. You look at the NYMEX ULSD, the NYMEX RBOB. If you look over the last couple of years, this is very normal for gasoline to be at a premium to diesel during the summer months and for diesel to be at a premium to gasoline in the winter months. Over the last year, you didn't see gasoline really overtake diesel during its prime gasoline demand season. And what we've seen recently is that diesel has been at about a 40-cent premium to gasoline, which is just enormous. It's coming off of almost 60 cents earlier this quarter. So all of this extra demand that's coming in for diesel and all of the kind of weakness we've seen in gasoline when it comes to extra production is just going to continue with IMO 2020. This is the prompt month that I've been showing you for the NYMEX ULSD. If you look a little bit further down the curve, you would expect to see usually kind of a less dramatic increase or decrease in prices. But even down the curve, you still see that people are expecting the NYMEX ULSD in 6 months' time to be almost 20 cents above RBOB. So it looks like something that will be sustained both in the fundamentals and what people are already putting in their books for what they think the price will be doing. So how this impacts IMO. Just for background, IMO we think will be impacting a lot of people in ways that they're still kind of getting their heads around. If you're a refiner, you've seen this coming for years, but 50 to 80% of your fuel oil demand will be upended overnight. So that means a sharp decrease in the price of your fuel oil. And what a lot of refiners have been trying to figure out is, can I upgrade my refinery to add more coking capacity or more hydrotreating capacity so that I can be making less fuel oil or less sulfur in the fuels that I do make. One of the ways that you can achieve that is by changing the crude slate. Depending on the type of refinery you are, using lighter sweet crudes that will just naturally be making less fuel oil. So this is going to have kind of global implications in the flow of crude that people are using just to put into their refiners. If you're a shipper, compliance is key. There are a lot of penalties that people have been talking about for non-compliance with IMO. If you're a shipper, then your margins are already fairly thin. You don't want to risk having to pay a financial penalty for non-compliance. So for a lot of people, it's making sure that they have the proper storage on their ships. If they need to clean out their storage to make room for a lower sulfur fuel oil, it requires different pumps. You might need to install a scrubber, which is something I'll talk about later. But you also have to adjust to inflated costs. Right now, fuel oil is definitely the cheapest fuel that's coming out of the refiner. It actually is sold at a discount to crude. So it's very, very cheap feedstock that you're running the global fleet of ships on. And you're going to be using something that will be for a little while quite expensive because people are still trying to get their heads around what it's going to look like. If you need to upgrade your fleet, there are going to be lots of costs associated with that, not just the $1 million it might take for you to install the scrubber, but you also have to dry dock your ship for a period of time. So you have to pay for the space to leave it there, but you're also essentially losing out on the money that you would be making by, making runs to various places and chartering. So this is going to be a big issue. Blending and engine concerns are always going to be an issue. These ships are huge investments, and they're very sensitive about the fuel that they would want put on it. If you're a storage company, it's about getting new tankage. A lot of people in Houston are looking for investment to add new tanks or to convert old tanks and to allow a new fuel oil into it. And suppliers, blending is really what's going to be most important. So looking at the blends. There is marine gas oil. This is kind of the most basic fuel that you can use because it's already a product that people are using in their ships. The issue is going to be about availability. A diesel fuel oil blend. This is where the creativity starts to come in. If you are using diesel, you're probably using ultra-low sulfur diesel. Within our world, we call it ultra-low sulfur heating oil because in the U.S. you wouldn't use the ultra-low sulfur diesel because there are renewable volume association costs associated with those barrels because you're using it as an on-road transportation fuel. This is not being used for an on-road transportation fuel. You can use ultra-low sulfur heating oil. It is the exact same specification, but it doesn't have that extra cost associated with using it as an on-road fuel. So you're probably using some blend of a distillate, ultra-low distillate, a slurry, which is going to come down to the availability in the market, a low sulfur straight run fuel oil. So these are barrels that are coming straight out of your refinery. And then if you can use any fuel oil that you have, maybe you have a low sulfur fuel oil, which is 1% or 10,000 parts per million of sulfur, then you'll use as much of that as you can because that's your cheapest feedstock. Everything else is going to come down to creative blends that you can make. The other thing that is going to come into consideration here is that you're going to try to create a blend that is both compliant with the specifications, but is as cheap as possible. So that comes down to using as little distillate as possible because that is the most expensive fuel that you can possibly putting into a blend right now. If you make 0.5% blended fuel oil, it's going to be costly. You're going to have to use tanks. You're going to have to buy the individual feedstocks. You might have to import the VGO. You might have to divert barrels of straight run that you would have normally continued to use as a feedstock within your refinery. Suddenly those barrels, you might need to use it in your fuel oil blend. Instead of keeping it in the refinery, you might have to go buy straight run fuel oil as a substitute for that. So you're going to start seeing these pulls on feedstocks and blend stocks for gasoline and just plain diesel that will start to be diverted into this pool. Every one of those individually in the blend won't be enormous. It's not like everyone's going to start using 100% diesel, but you're talking about 5 million barrels in global demand of bunkers, and you're going to have to start getting creative with the blends. So looking at what that looks like, this is what Platts Analytics thinks that the demand is going to break down into in 2020. The 2017 blend is going to show you that people are using distillate bunkers or MGO right now, but there's a lot of that high sulfur resid bunkers. This is the high sulfur fuel oil that you can use in your ships right now. It has 3.5% fuel oil or 3.5% sulfur. It's very dirty, and we're going to have to break almost all of that down into blends of other things. So we think that the distillate bunkers, which is diesel or MGO, is going to grow a lot. So you're adding about 1 million barrels per day in just distillate demand. And then you start looking at the distillate demand that will have to be blended into other things. So this is another 1 million barrels. There will be some kind of blend of a new fuel for 0.5% that will probably be made from fuel oil, slurry, straight run, and diesel. And then you're talking about another 1.3 million in some blend of low sulfur fuel oil that you actually can use with some of these other feedstocks of diesel and of gasoline blend stocks. And still just a little bit of high sulfur residual fuel oil. We do think that there will be some high sulfur fuel oil that can still be used because a lot of ships have been installing scrubbers. But essentially what you're talking about is destroying almost 3 million barrels per day in high sulfur residual bunkers. You're going to replace that with about 1.2 million barrels per day of low sulfur residual bunkers and an additional 2 million barrels per day in distillate bunkers and another million in non-bunker diesel and gas oil demand. So just a huge baseline increase in the amount of use that we think that there will be, and just breaking down that 3.5 million barrels of residual fuel oil demand into so many different blends. It's going to come out differently, and it really will depend on who you are as a supplier or a blender as to what you can make. But we think that it will be some combination of just a baseline increase in diesel and then more increases in diesel and gasoline blend stocks to make 0.5% compliant fuel. This is the same thing kind of reimagined in a more graphical way. You can see the huge drop in high sulfur residual fuel oil and how that's being taken up by low sulfur fuel oil, distillates for blending, and then just plain distillates. You do see LNG at the top there. There is a small increase in LNG that we expect, but it's just not ready infrastructure-wise to be deployed in a huge solution type way. There just isn't the scalability available yet in the infrastructure for that. So what does this actually mean for diesel? This is I pulled these numbers yesterday. This is the forward curve. So this isn't our projections like the last two slides. This is just actually what people have been trading in the forward markets for diesel. These are the cracks. So going back to what is, if I run Brent crude through my refinery, what is the refined products spread from there? So we're looking at right now in the US, we're the purple line, we're about $13.50 crack. We think that that will go up to about $15. At various points it could be close to $16 come beginning of 2020, but you do start to see that lift. That's because this is going to be such a huge blend stock in remaining compliant with 0.5% fuel. This is the easiest of the potential solutions, and that's why you start to see that lift. In terms of bunkering, I guess just to put it in perspective, the U.S. has a relatively small bunkering market. The huge bunkers markets are Singapore. Singapore has more than 10 times as much daily bunkering activity as we have in the U.S. So bunkers in Singapore, you're going to start to see a much bigger impact in the markets there, just in terms of its impact. Right now you can see that Singapore has a much weaker crack and it goes up quite a bit. In terms of how this is going to impact diesel flow globally, Singapore is long diesel, and they do occasionally even export to Europe, which is short diesel. So we also export to Europe. So it'll be interesting to see how Singapore remains, if they are quite as long as they usually are, if they might start to look for creative outlets for importing some diesel. Same with Europe. Europe is a much bigger bunker market than we have in the US, and they are already short diesel. So I think that a lot of the blends that our fuel oil teams in Europe are coming up with don't have very much diesel in it because they don't actually have, a lot of diesel left, after you cover the baseline demands across the continent. So we might look to export more diesel to Europe. Again, this is in addition to, potential Mexico demand increases, and in addition to blending increasing within the US for this. So these are all factors that people are kind of weighing against each other as to what the actual impact will be beyond just simply blending the diesel. This is what the forward curve looks like in the outright price. So that was the crack. This is just outright dollars per barrel. The New York ULSD swaps, you can see that the value is fairly flat because, usually the crude out for, 18 months doesn't move a ton, but you can really see the drop off in Gulf Coast high sulfur fuel oil and that spread, the green line, really increasing more than $35 per barrel. That is hugely important because that is how people are going to be looking at whether or not they want to install scrubbers. So this is a chart that's basically showing what is the spread that people, going back to the beginning of the year through right now, what did people expect the January 2020 spread between diesel and fuel oil to be? At the beginning of the year, people thought that it was going to be about $35 per barrel, which is kind of normal. And then as people got more and more concerned with 2020, I think diesel became much more clearly the feedstock of choice to make compliant fuel oil. You started to see that spread between diesel and fuel oil really blew out at the middle of this year to almost $50. And that's when you see that blue line start to go up. It's very much causation and correlation. As that spread blew up, that is when the scrubbers started to, on order, increase. So as you see the number of scrubbers starting to come online and to grow, that's when you start to see that sulfur spread between diesel and fuel oil started to come back in and is now closer to about $40 a barrel. And it's because people think that there will be more scrubbers on the market and therefore less need for diesel in those blends, more use for fuel oil come 2020. So it's a very closely correlated market in terms of how much spread is there between these two products. And then as that kind of waxes and wanes, that's when you start to see scrubber installations pick up. This is what we think that the scrubber market will look like in 2020. We expect there to be about 40 to 50 installations per month, which would put us well over 1,500 going into 2020. This is a reference case. We've revised this more recently. We actually think that January 2020 could be as much as up to 2,000, 2020 or 2,200 by January 2021. And if you kind of take that out further, everyone is kind of gearing up for 2020. What does this look like 5 years down the road in 2025? We think that could be up to 8,000 ships that have scrubbers installed in them. And this is kind of lumping together both the scrubbers that we think will be ready to go on January 1st, 2020, as opposed to just on order. There's actually a very long line of ships, particularly in Asia, to get a scrubber installed on them. Even if you've committed and you said, okay, I'm going to do this, you might still be waiting for up to a year just to install the scrubber. So in terms of how this has kind of changed, because as you can see, people are changing what they think the diesel impact will be over time, I pulled the forward curves for this chart on the left going back several years. So you can see that the cracks over time, they kind of fluctuate globally. But you can see the huge spike that people thought there was going to be even just 6 months ago in May. What did they think that the diesel crack was going to be globally? We were thinking it was going to be $25. We thought that it was going to be very, very strong in May. In October, I pulled the numbers again, and you start to see them kind of come down a little bit. Some of this was because this was around the time that people thought that the economy was maybe going to slow down sometime soon. There were fears of a recession at some point. And so you started to see that the scrubbers were going to pick up too. Suddenly what we thought was going to be a $25 crack spread in May has now been revised down to about a $20 crack spread. And that has, going back, I guess, to the slide I had earlier, that's been coming down even more to 18 now by January 2020. So the, I guess, severity that people think that the diesel market will be impacted has kind of been scaled back over time. It both has to do with the scrubber installations and the general concerns about the economy, which is so closely tied with diesel demand. And it's kind of hard to talk about IMO without talking about compliance. So this is one of the last things I wanted to touch on. A lot of people will talk about, how they expect all of these ships will be non-compliant. When you look at the global demand of fuel oil in the world, a lot of what is really using the bunker, the fuel oil in the world, are actually only 25% of the ships. These are the huge ships. They're the ones that are carrying all of the really big, dry and liquid fuels around the world, and they make up 85%. 25% of the ships in the world make up 85% of the bunkering demand. So technically, you could have 50% of the world's ships be non-compliant by, IMO standard, and as long as that 25% is complying, you're still talking about almost 100% of the world's, bunkering demand needing to be 0.5% compliant. So the numbers can get a bit misleading when people talk about percentages of ships that might not be complying with this. It really does come down to a relatively small number of ships that make up so much of the bunkering demand. So that's what this chart is kind of showing you. It's basically saying that once you get to the last 30% in terms of just the number of ships on the market, you're only talking about 5% of the global bunker demand. So you have to kind of think about what are the ships, number of ships, what percentage of the actual global demand are you talking about? We think that the really big ships, the ones that are carrying and making up the majority of the bunker demand, they will be compliant. These are the huge shipping companies like Maersk and Aegean that have already said that they are going to be compliant. So there will probably be non-compliance. All of the same things, concerns about, whether people will really be able to be policed on this, that's all true, but these huge shipping companies are not going to risk being non-compliant in something like this. And then touching on gasoline, this is what the forward curves for gasoline look like. It's a bit less clear because gasoline has kind of this shape to it because there's so much seasonal demand. But this is kind of a chart showing you what various actions to maximize IMO compatibility might do to diesel or to gasoline production. So if you are running an FCC and you want to change the cracking severity to maximize your distillate, you want to make more distillate than you are gasoline to take advantage of the fact that diesel is going to be such a strong market, then you're going to lower the amount of gasoline that you're making. If you want to run your FCC at lower rates so that you can use those feedstocks like VGO that you need to run your FCC, if you want to start making more of your VGO available to the bunkering demand pool, then you're going to make less gasoline because your FCC is your primary gasoline producing unit. If you want to run your reformer at lower rates to maximize your distillate cut from your crude distillation unit, then all of these things are leading to lower gasoline production. These are all things that, depending on your approach to it, if you're either trying to make sure that you have the most amount of blend stocks available to blend a 0.5% fuel oil, or if you're just a refiner who wants to take advantage of the fact that diesel is going to be the most expensive refined product that you can make and therefore the largest crack you can take advantage of, there is going to be a knock-on impact to gasoline. I will say that there is kind of another camp to this, which is that if you're generally running your refinery at the highest rate that you possibly can to try to make as much refined products as you can, you're going to be making a lot of gasoline. If you're diverting some VGO, if you're trying to make the most diesel as you can, you're still going to be making a lot of gasoline. So this is kind of, they're kind of two camps on what the gasoline impact is going to be. The Platts analytics view is that it could be quite bullish for gasoline because we think that people will be focused so much on supplying the diesel pool, but that is another perspective that's out there. And then to wrap it up, because I think that I've run long, this is just kind of a breakdown on IMO 2020. We think that there'll be increased crude throughputs, which will lead to higher oil prices. We think that all the refined products will receive a boost simply because there's so much more demand that's coming online that's going to start pulling at these, which will impact the consumers. The freight rates will be impacted, which break up some of the cost to move barrels around globally. Refinery configurations will impact other commodities, particularly petchems and coke and all of these things, and then more high sulfur fuel oil will be burned in utility where it can't be burned on ships anymore. So this is kind of like a very big overview of it. I know this is such a sprawling topic, so I'm going to stop now and turn it over to questions.
Thank you so much, Beth. That was great. I'll invite our audience once again. If you have a question, please utilize the chat box in the lower part of your screen there and type in your questions so that we can ask our panelists. And while people are submitting their questions, Beth, I just have a couple questions for you. I was wondering if you guys had looked at projected refinery upgrades, or maybe even refinery upgrades going on currently, and or refineries looking to increase their capacity because of IMO, and what impact that's projected to have.
We've heard of that. Basically, if you are a refiner who's considering installing a coker at this point, it's too late. You had to have seen that coming several years ago to have it, ready to go by January 2020. So we haven't seen the kind of huge increase in, I guess, large-scale projects. I think that what we have seen and what we have heard about is that there could be a heavier refinery maintenance season this coming year, as a lot of refineries are going to be focused pretty strongly on making sure that their hydrocrackers and FCCs and coking units are working. It might, I guess, just work for them to be paying more attention to those units. In the U.S., we haven't really seen the bigger projects when it comes to big upgrades or big, we're gonna install like a completely new unit here. We haven't really seen that so far. It's kind of like with the gasoline production increasing every year over the last 5 years. It's not because we've added more refineries or more gasoline producing units. It's just about how you choose to use them. So I think that that's really been the focus here.
Got it. Okay, and we have a question from one of our attendees. What will be the role of biofuels, for example, diesel derived from biomass?
It's interesting. I was presenting basically the same presentation with a couple of months ago, different content at that time, and I was presenting it with our biodiesel reporter, who also covers ethanol too, because there is a lot of questions when it comes to just the reality of bio blending in the U.S. It can have an impact on IMO 2020 because you have to make sure that for bunker compliant fuel, that, as we've said, it's kind of the Wild West in terms of what the specification of that fuel will be in 2020. There are a lot of biodiesel and biofuel related specifications that actually can't really be in a 0.5% fuel oil blend. Something like FAME content that would be blended into diesel if you're going to use it in the U.S., it can't be in a 0.5% blended fuel oil because that is going to create more viscosity than the ships want to handle. It can coagulate, and it can make the bunker fuel off spec. Particularly in Houston, there have been a lot of concerns about off-spec fuel oil this year that have gotten like a lot of mainstream attention. So I think that, I guess, the focus on making, the separation between biodiesel and diesel that's suitable for bunker blending is going to become much more important. And so you might see that become, part of more of the downstream conversations to make sure that if you're going to blend diesel into your fuel, there's going to be a lot more, need to segregate out the biodiesel because it simply shouldn't be in the blend if the diesel is going into the fuel oil.
Okay, thank you. And then I have another question for you. So in terms of any price spike that you would expect or that you're, already starting to see moving forward, approximately how long do you anticipate that spike lasting?
Yeah, that's something that we get questions on a lot. It does look like by the scrubber adoption rate and simply just adjustments that the world makes naturally relate to various things. We don't expect the increase in prices to last longer than, and this is Platts Analytics, this isn't me, but I'm kind of sharing their view, to last longer than 2 to 3 years. That is when you start to see the forward curves flattening out a bit and starting to come down. A lot of it does come down to scrubber adoption rates. We've seen that when the gas oil diesel sulfur spreads blow out the way that they have earlier this year to almost $50, that's when you start to see that people are saying, okay, I can see the money here. I can see that over the course of a year worth of, what I as a ship owner am going to burn, I can see that that $50 spread between my two fuel options is going to make up for the $1.5 million I have to pay to install my scrubber. The idea was that you have to really see the sulfur spreads widen out before you see the large-scale adoption of scrubbers. We've already seen people pricing that into their forward curves, and that's why the scrubber adoption has picked up. We think that come 2020, these sulfur spreads, even though people are trying to kind of predict it, we see it in the forward curves that people are already trading. We think that once people see that, once that's part of their reality because they're using these blends, that's when you'll start to see more and more scrubber adoption. So we think that it'll take those couple of years partially just to wait and let people kind of see the reality of what the diesel blend would look like versus what they could get from a high sulfur fuel oil, which is going to become very cheap by comparison. That's when you'll start to see that the scrubber picks up, and then it'll take a little bit because, like I said, there are going to be waiting times depending on where you are in the world. But we think within the first 2 to 3 years, that's when you'll start to see the prices stabilize, come back into something that's more normal between these two products.
That makes sense. And I have another question from an attendee. I'll read it for you here. From the data you presented on projected diesel cracks over the next 12 months, it looks like traders are anticipating a less significant impact on the market compared to what they expected earlier in the year. Some headlines and analyses suggest major disruption in price spikes in diesel and crude prices. This has made many stakeholders jittery. Would you suggest that the impact on the market is less significant than these stories project?
It's hard. I mean, honestly, I've heard a lot of people present on this, and I wouldn't even say that there's uniform approaches. I was at a panel where someone stood up and said this is going to be the most disruptive event in the oil industry maybe ever, and the next person said, we actually think it will be fine because markets of this size do tend to adjust. These are very sophisticated markets. The Platts Analytics view is that we do think this will be disruptive. This is a lot of barrels of diesel that are going to need to be diverted into the bunker blending pool. Something like gasoline is a very sensitive, gasoline is all about blending. You're talking about diverting blend stocks away from the gasoline pool or just feedstocks into the refinery that could make gasoline and using them in your 0.5% blend. That is disruptive. How disruptive it's going to be, it does look like people are kind of scaling back in terms of how significant they think that the diesel prices are going to jump. Like I said, the cracks in May were $25 and now they're below 20. And if we continue that trend, then it's just going to continue to come in. I do think that there will be an impact because these markets are sensitive to any kind of change, but it does seem like a lot of the uncertainty that caused the initial really big crack increases at the beginning of the year, people are kind of getting their heads around it. We've heard that 0.5% fuel oil, there are cargoes that they're loading it. They're starting now to try to make sure that they're ready for 2020. They want to make sure that they understand the blends that work for them. There is going to be some, you can't always count on everything working all the time, but people are already starting to blend this now so that there won't be as big of a car crash in 2020. People are really, they seem to be understanding that this is going to happen and that these are the feedstocks. Maybe it's a little different from day to day, but this is kind of the baseline impact that there will be. And, you know, like I said, I spent most of my time at Platts covering diesel. I've talked about this with diesel traders and with diesel suppliers. And even just 6 months ago, talking to them about, you know, what do you think about IMO? Have you guys been, you know, in meetings about this? What are you thinking about this? There was so much uncertainty and so much still questions about basic things like, is diesel really going to be the blend stock here? Or is IMO 2020 even going to happen? Like, are they going to push it back another 2 years? These are all questions that even 6 months ago people really had. And now when you go talk to them, major companies are actually converging their diesel and fuel oil desks. Companies like Trafigura and BP, we've heard about a lot more collaboration between these two teams because they know that this is happening. So I think that part of the scaling back that we've seen even just this year is because of, you know, people getting their heads around it, but then it's also some things in the diesel impact like softening economy projections. So I think there are a couple different things happening, but basically it does seem like people's projections are scaling back a bit for the impact.
Thank you so much, Beth. I don't believe we have any more questions at this time, but attendees, if you have any questions after the webinar is over, please feel free to email either myself or Donovan. Our emails are on our website in case you don't have them. Beth, thank you so much once again. This was really great. And to our contributors and to Beth, happy holidays to everybody, and we hope to see you next year in 2019 for our next series of webinars. Take care, everybody.